Welcome back to Morning Trade Live. I'm Sam Vardas. On the floor of the New York Stock Exchange, let's welcome in our next guest to talk about the software space in 2026. Joining us now, very pleased to say, is Steve Koenig, who's the US Head of Software and Services Research at Macquarie. Very good morning to you, Steve. Happy New Year's Eve. Thanks so much for joining us. So when you do a pulse check on software, is it still beating?
Yes. Thank you, Sam. The pulse of software is still beating. I think we're set up to, have a pretty good momentum going into 2026. I think we're seeing some positive signs. We track job postings for 40 growth software companies across the space, and job postings have been ramping for throughout Q3, July, August, September, October, and into November. I think that's positive. And I think, we're seeing good demand signals out there. So, it's going to depend on the performance of each company, how they're positioned, how their AI stories are playing out, et cetera. But broadly speaking, the space is positioned pretty well to perform.
I love that you're talking about jobs, and I love that there are opportunities out there. I know that we're obviously going to be talking about the performance of software, and you've got a couple of top picks to bring us, but let's just scratch that a little bit, because where are these jobs? What opportunities are some of these companies providing? Because all year we've been talking about the labor market weakness, the deterioration. Obviously, we've seen these huge high-profile corporates obviously slashing headcount as well. People are fearful. We're seeing that in the consumer confidence sentiment surveys as well. So where are they?
Yeah, that's a really interesting question, Sam. And if I were to generalize, when we look at where the job postings are concentrated, it's tending to be more on the sales and marketing side, not so much not so much R&D and the software development. Companies are getting a lot more efficient there. Maybe AI can bring efficiencies to sales, but I think the catalyst here is, more generally speaking, software companies want to get more people out there, pushing the adoption, especially of their agentic AI products.
Okay, so it's good news then that at least sales and marketing teams, they're looking to bolster that. No doubt that's going to show up in some of the numbers. Talk to us about some of your top picks here across the sector, because, as a sector, it has struggled in 2025. Hopefully things will get better in 2026, but you like Autodesk, Datadog, Zscaler, Outperform ratings on all those three names. Why those and not sort of the others, which you have sort of more neutral ratings on?
Yeah. I think those three names, one commonality among those three names is that they all have leverage from AI adoption. And in particular, a lot of the money going into the investment dollars flowing into these AI native private companies. For example, Datadog is selling more and more of its observability software. This is software that assures the performance of your full cloud application stacks into those AI privates. And so there's good exposure there. I think in the case of Zscaler, you've got a cybersecurity company that is going to be even more in demand in terms of their real-time zero trust platform and its ability to stop attacks, which are increasingly going to be automated with AI frameworks from the, used by the bad actors. And then lastly, you've got Autodesk is a beneficiary of, they're actually creating their own foundation models for design. They're the design leader in the architecture, engineering, construction space, and they also do work in manufacturing, product design, and game design with their media and entertainment group. So they can benefit very much from the adoption of these generative models for high-end design work. We're not talking the kind of consumer tools that Google or OpenAI are putting out, but we're talking about bringing automation to design, to architectural design and construction.
Mm-hmm. So 2025, a bit of a tougher year for software. I mean, as far as the underperformance is concerned, does it start to get better in 2026 as far as you're concerned, with some of the questions in the market right now around some of the CapEx, the leadership and valuations and the financing?
Yeah, great question. There's some nuances there. And I would say, if you look at a large cap software index like IGV, it's lagged the S&P significantly this year, still up. But we look at a broader index of 40 growth software stocks that we think are better representative of the sector. And that's performed pretty well in line with the S&P this year. And I think the story there, the dichotomy, is that there's been some fear that these large SaaS companies, large cap companies like Salesforce or ServiceNow could be eventually disintermediated by AI from the startups. And I think people are starting to realize that no, actually the SaaS companies, they have the workflows already deployed at the clients. They've got relationships with the customers, and they've got the means to bring to actually drive adoption of AI. They're best positioned to drive this adoption. So I think some of those fears are going away. But broadly speaking, like if you look at design software or cybersecurity or cloud infrastructure like observability that Datadog has, I mean, these things are all poised to continue to do well next year and have done well this year.
We'll be watching a good look at the software space. Thank you so much for that, Steve. Steve Koenig from Macquarie there. Appreciate your time. Let's trade Datadog now with George Tsilis, Senior Markets Correspondent. And we've got an example trade for this name, George.
Yeah, I think if you look at Datadog, it's down significantly since it peaked around mid-October. But nonetheless, there seems to be price action that's corresponding or maybe confluent to a rising 200-day moving average. So it looks like that's an area that might provide some intermediate term support on Datadog. So in this case, with the low volume today, buying some calls outright doesn't make any sense. So what I'm going to do is I'm going to structure a bullish to neutral trade, taking that rising 200-day moving average in mind, which is approximately around $135 in price. So I'm going to go out to February and sell a put spread, taking that, like I said, price level in mind. I'm going to sell the 130 put, and then simultaneously I'm going to buy the 125 put below that. So altogether, this structure is designed to earn a credit. In this case, it's around $1.75 a share, $175 a contract. So the whole premise behind the trade is to settle price right around the 130 or higher level. So it doesn't have to make a move for this trade to actually generate that max profit of $1.75 a share, as long as the stock stays above that 130 area between now and expiration at 51 days. If you do structure this trade, you have to consider the risks. Break even on the trade is 128 and a quarter. And then, of course, the opposite of the $5 wide spread minus the credit is $3 and a quarter. And that only occur at max risk if the stock hits 125 or lower. But again, the technical correspondence at that 135 area matches the probabilities of that 130 strike that I'm securing in this trade. The delta on that trade, or that short strike, is around 35, which implies about a 65% probability of profit by expiration.
Okay, good look at Datadog for us this morning. Trading down 0.6%, 136 and change today. Thanks so much for that, George. I'll check in with you a bit later on in the day.